Hello again, everybody. You know, whenever I see someone post a political diatribe on social media, I almost want to ask that person, do you really think all of your yelling and screaming is going to change hearts and minds? It's almost like you expect the person on the other side to go, oh, well, when you put it that way, when you yell the words online and you use all those four-letter colorful words, okay, now I see your point. You've completely changed my mind.
I don't think so.
Yeah, I don't think so either, Mr. De Niro. But look, honestly, when it comes to politics and the debates, and man, the temperature in the room here in this country has really been turned up in recent years. And that's, to a point, part of what makes America great. We've done it to certain degrees forever and ever. There's nothing wrong with talking politics. I talk about it from time to time, of course, on this show. What I also, though, warn people and advise people is not to use your personal political leanings and bring that over into your portfolio and structure a portfolio based on that. It just doesn't work. In fact, just a couple of weeks ago, I did an episode on geopolitics around the world and personal politics. I had the data. I showed the charts of how it doesn't work and why it doesn't work. So if you haven't had a chance to see that, please go back. Now, this week, I am going to step over the line a little bit. Bear with me. Let me explain. I'm actually going to get into two political hot potatoes that have been around here recently in recent weeks and months. And I will give a little bit of my own personal opinion about it, and more importantly, what we as investors should think about it. So I think maybe hopefully, by the end of the episode, you will know now where I personally stand on a couple of these hot potato issues. And again, as an investor, do you do anything about it? So first, let me start with this. Imagine this scenario. You are the CEO of a very large company, well-known blue chip company, and man, you have been killing it. Congratulations. Business is good, billions in revenues, the stock's been going up, the board has given you bonuses, stock options, and all that. But then disaster strikes. It's not your fault. And we'll use a real-life example. Let's say the pandemic. Let's go back to 2020 and that happens. And your business is in an industry that is really hit hard by the pandemic. All your workers have to stay home. And it's not like you have a business where people can work remotely. So your revenues are dried up. But your expenses don't go away. You still have to pay health care for your employees. You still have to pay your rent. You still have to pay the bills, all of this. You've got inventory. But man, you just don't have the cash to be able to pay that because your business is dried up. So extreme times call for extreme measures. You enter into the debt market. You have to finance operations just to keep you breathing during this time. Your board approves it. They know it has to be done. The majority of your shareholders are good with it. Even though your stock does go down, they understand it. You know that when this is all said and done, because of the success of your business, that things will thrive again and you'll be able to pay off that debt in a short amount of time. Let's say that happens. Okay, that's one scenario over here. Now the contrasting second scenario. Same premise. You're the CEO of this large company, very successful, but this time, no disaster at all. Man, things are going great. The economy is booming. Your industry, your particular business is going very, very well. But then you get a little greedy. This is what happens sometimes in corporate America. You start extending the finances of the business a little bit. You buy this big new tower, this multi-office, beautiful tower in downtown Metro, wherever, for you and your execs, and you've got your gold-plated chairs and nice new bathrooms and all of that stuff. You buy some newfangled technology, which you think is going to separate you from your competition. Turns out, technology doesn't work. It's a boondoggle. You want your employees, you've got thousands of them to love you, so they weren't expecting it, but you shower them with all kinds of extra bonuses and parties. Bottom line, you are spending money that you don't have, and so you are going into the debt market to finance that. So the difference here, you went into some debt to survive during bad times. Here, you went into debt during good times. Doesn't always work out well here. Some of you are on to me, or where I'm going with this. you're now understanding that I'm talking about our government. Our government was here during the pandemic. Our government, unfortunately, is here. We have good economic times that have been going on now for a couple of years at least, post-pandemic. And yet, our annual deficits continue to go higher. And our federal debt now topping $37 trillion. What happens, unfortunately, the next time we have the inevitable economic contraction? What happens when we have a deep recession, which will happen someday, where we always go into the debt markets and add more to our federal debt? We're doing it now during good times. This is unprecedented, my friends. Let's take a look at a chart right now. You're going back now to really 25 years or so. This is the annual deficit, or in the first 2 years over there, you can see we actually ran a little bit of a surplus back in 2001. And then after that, some small deficits. Now, let me stop there and say, there is nothing wrong with having federal debt. And there is nothing wrong occasionally having a deficit. Most of us live that way. You might have a mortgage on your house, a car loan. You might still have some student debt. Even very wealthy, successful people know how to use debt to their advantage. There is nothing inherently wrong as long as it's done responsibly. Now let's go back to the chart. Look at the blowout that occurred during the type of crisis that I was referring to there. This time it's the great financial crisis, and the debt explodes out, as you can see, in those middle years, '08, really through about 11 and 12. And then our deficits, they were still there, but they shrank back to pre-great financial crisis days. All good with that. Now look at the right side, those last 5 years. Then the next crisis, the pandemic. We blew the deficit out of the water. Here's the problem, though. Look at the last couple of years. In fact, look at 2024. The deficit increased even more during good times. And now in 2025, here we go again. And my friends, we have potential problems down the road. I have been on this podcast before in some other episodes. I've written about this in my weekly commentary, that for years, in fact, even decades, I have never jumped on the bandwagon to say, oh, you know, all this debt that we're adding, this is going to really, we're burdening our grandkids with it, and it's going to kill us. We've been hearing that since the 80s and the 90s and the 2000s. And I always said, I don't think so. It'll matter when it matters. The interest that we pay on our debt historically was always about the same because the interest rates went down. Well, guess what? I think you've probably heard the news now. The interest that we pay on our debt now is a growing higher percentage of our economic growth, our GDP. We are now paying more interest on our debt than we spend on our defense budget. That's the first time in history. Now I'm back on the bandwagon. This is out of my pay grade. I don't offer any solutions. It's easy to say, we just need to cut this down and cut spending. We all know that. And yet our politicians, the fiscal hawks, just don't exist anymore. We just have to take care of ourselves. So as investors, here's my advice for this. If this does play out as I'm concerned, that the next downturn that happens, we add even more, and then the bond market, and that's where it'll start, the bond market will throw a conniption fit. The bond vigilantes now will demand much higher yields. At that point, you will not want to own long-term U.S. government bonds, in my opinion, down the road. You might own fixed income in corporate bonds. Think about that. Many investors, especially big institutional investors, if not foreign investors, might actually feel that corporate bonds in well-financed, successful businesses are safer than U.S. government bonds. That's never been the case. That could be in our future. If that scenario plays out again in the stock market, you could have small cap stocks, which have seen a little bit of a rebound here recently. They would suffer big time. They do not do well in economic debacles like that. So this is something that I will come back to occasionally on this podcast. This is something that I write about occasionally in my weekly commentary. So please keep coming back to these things, because my advice will start to get a little tighter and will come with perhaps a little bit more urgency, but I don't think that's happening anytime now. This is just kind of a pre-warning, so put this in your hip pocket. Okay, so my second topic is this. As we all know, President Trump is not too happy with Fed Chairman Jay Powell these days. I would say there's kind of a fight between the two, but that's not really accurate. It's pretty much a one-sided fight. And the Fed chairman has been vocal about it, not so much the debate with President Trump, but why he is not cutting rates that Trump wants him to do. And Powell has said, look, normally, in a normal environment, I would be cutting rates. I think the economic data suggests that we could cut rates. The only reason I'm not, says Powell, is because I don't know what these tariffs are going to look like in terms of their inflationary pressures. We don't want to cut rates and then have to turn around and drastically raise them. That is not healthy for the economy. And he'd be right. And I had sided with that until recently. I'm with President Trump on this one. I am. And we're just talking specific policy issues here. The reason I've changed my mind is my fear that all these tariffs would cause dramatically higher inflation has really gone by the wayside. The more research I do and the more that I look at this. Think about when that Liberation Day happened and the markets had a conniption fit. That got the White House's attention and they backed off and started talking about these 90-day pauses. Don't underestimate what happened. I don't think they're going to want that to happen again. They're still doing it. They're still kicking that can down the road, so to speak, and pushing tariffs down the road. Now, we are going to get to the end game, and maybe it's a little bit higher than we wanted, but the market seems to be numb to this now. And we're seeing more corporations start to take or take the higher prices and eat a lot of them. Any company that is able to do that, by the way, they can't pass on those costs, will start to absorb that a little bit. The companies that do have to pass on the costs, we as consumers, we kind of collectively look in other areas. Well, that's a product or an industry. Look at the prices go way up. I'm not going to buy that anymore. I'm going to buy this over here. So I don't think inflation is going to be this across the board economic jump in inflation like we saw sort of a couple of years ago, immediately post-COVID. I think it will be relegated to certain industries and certain specific companies that as investors, we just have to avoid. Now, here is the biggest reason why I believe the Fed actually should start cutting rates now and not wait any longer. One of the names, and I hate the fact that the president has to always resort to name calling. It's unneeded. It's ridiculous, childish. With that said, one of the little pet nicknames he has for Powell is Too Late Powell. Too Late Powell. Okay, I can kind of have fun with that one because there's truth to it. And it's not just Jay Powell. I'm not jumping on him. I actually like the Fed chairman. This is true for generations of Fed chairmen. The problem is they look at today's data. They're very data dependent. I get that to a certain degree. But the data that they're looking at is coming from economic activity in the rearview mirror. It doesn't exactly give us any vision to what's happening, even though sometimes that vision is somewhat clear for us. And right now, we see parts of the economy that are starting to slow. Powell knows this. That's why he said in a normal environment, I would start cutting rates. But I don't want to because I think there could be the potential for inflation related to tariffs because I don't think we're going to have that runaway inflation anymore like I maybe once did. I say go ahead and cut now. I tasked my partner, Brandon Mallinckrodt, with a chart that I wanted to see because I wanted to see the connection between what the Fed controls in terms of short-term interest rates and where inflation is, the CPI. And I want to put that on the same chart and sort of know or notice the correlation between the two. I already sort of had this intuitive feel of how the two played with each other, but I wanted to show the data. There's one thing that really jumped out at me when Brandon gave me the information. Here it is. I want to share it with you. What you're seeing here in the green is what the Fed controls. That's the short-term interest rate, the Fed funds rate. The blue line, and we're going back 40 years here, the blue line is inflation, the CPI. But see those gray bars? That's what we want to look at. Those represent recessions. There have been 4 of them since the mid-1980s. Notice what's happening here. They all act the same in terms of the green and blue lines. Look at the green line right before the recession. The Fed is tightening tightening, right? Right before each gray bar, that the green line's going up and up and up, and then they stop. Meanwhile, the blue lines, inflation, also doing the same thing. So that makes sense. As inflation's going higher, the Fed should be raising rates. But as soon as they stop, soon after, boom, recession. That tells you something. Think about this. When the Fed is raising rates or even lowering rates, whenever they take any action, it takes a while for that activity to have any impact on the economy. So if the Fed starts lowering rates now, and typically they'll only do it 0.25% at a time, and then they wait for the next meeting and it's another 0.25%. It could take months before they even lower it 1%. You're talking about a lag of at least 6 months and sometimes 12 months. Let me go back to the chart and show you what I'm talking about. And let's look at that middle one. That's really it's the internet. The internet bubble that's kind of cratering there. See the green line? They finally stopped raising rates, but as soon as they stopped, while inflation is still going higher, but it's too late. We've got a recession. If they had stopped raising rates earlier, we may have avoided the recession. Look at the one right after that. Same thing. Dramatic rate hikes as we started towards the Great Recession. That's why it's a lot thicker there. They stopped, but it was too late. The recession, as it turned out, was inevitable. That's because of the lag time between rate hikes or lowering of rates before they have an impact on the economy. And that's my fear, friends, that just sitting here and doing nothing when we're already seeing parts of the economy weaken. The latest jobs number, the headline news is, wow, more jobs were created than expected. Look beneath the headlines. More than half of those jobs were government jobs. Those are non-economic productive jobs, not the federal government. That actually declined because of DOGE cuts. We're talking state and local governments, where more than half of the new jobs created. Real economic producing income or producing jobs were very minimal and were actually lower than expected. There's a lot of data out there that suggests, and the Fed knows this, that maybe they should start lowering rates. So again, what does this mean to us as investors? It's the same as the first one, really. This is something that's not going to play out for a while. But if it does, and that chart shows we got another gray bar in front of us, probably not till 2026 if it does happen, then we're going to have to do the usual type of investing that occurs in economic recessions. As opposed to the first one where I said watch out for bonds, especially long-dated bonds, a recession typically is good for long-dated bonds. Yeah, folks, we got our work cut out for us. We got a couple of different scenarios that will produce different kinds of actions needed in our portfolios. So please, let's do this together, all right? Come back to the podcast, read the weekly commentary. I've got some other things, including a resurrection of the Dollars and Cents show coming by the end of the summer, and we'll continue to address this as things play out. I hope this is helpful to you. Again, please subscribe, pass it along to friends, family, neighbors, and be the big hit in your local area by passing this on. All right, we'll talk to you again next week.